Welcome to the middle of the decade where the financial rules are shifting once again. When we look at how to invest $10,000 in 2026, we have to acknowledge that the post-pandemic recovery is over and we are entering a phase of technological maturity. $10,000 is a significant milestone because it represents the transition from being a saver to becoming a true investor. For instance, if you had invested this amount in a simple market tracker 5 years ago, you would be seeing the massive impact of compounding interest today. The main idea is that in 2026, we are no longer looking for speculative bubbles, but rather for sustainable growth driven by real-world utility and cash flow. By the end of this video, you will have a clear blueprint for turning that initial capital into a robust wealth-building machine. Making your money work for you starts with understanding the current landscape and making informed, strategic decisions. The first $4,000 of our $10,000 total should go directly into a broad market index fund. This serves as the bedrock of your entire investment strategy because it provides instant diversification across hundreds of different companies. Think about how a total market fund, like the Vanguard Total Stock Market Index, has historically captured the growth of the entire American economy. By owning the entire market, you benefit from the collective success of innovative giants and emerging leaders alike. A concrete example of this is how index fund investors stayed profitable throughout the early 2020s, while individual stock pickers often lost their shirts. This core position ensures that your portfolio remains stable and grows steadily alongside the global economy. You're building a foundation that can withstand market volatility while providing long-term capital appreciation for your future self. Next, we are going to allocate $1,500 to the semiconductor and artificial intelligence infrastructure sector. This is essential because by 2026, artificial intelligence has moved from a speculative buzzword to the primary driver of corporate productivity. We are seeing companies like NVIDIA and Advanced Micro Devices provide the essential building blocks for every major industry. Consider how the demand for high-performance computing chips has consistently outpaced supply as every corporation on Earth tries to automate their core processes. This part of your portfolio is not about chasing a trend, but rather about owning the literal tools that power the modern world. By investing in the hardware layer of the digital revolution, you are positioning yourself to profit from the massive infrastructure spending. Our next $1,000 will be invested in the green energy and nuclear power transition. The reason for this specific choice is that the global demand for electricity is skyrocketing due to electric vehicles and massive data centers. You can look at the resurgence of nuclear energy companies and uranium producers as a clear example of reliable baseload power. As governments continue to provide massive subsidies and tax credits for clean energy projects, these companies are seeing their balance sheets improve. Investing in this space allows you to participate in the inevitable shift away from fossil fuels while capturing the growth of a necessary utility. This allocation ensures that your portfolio is aligned with long-term global policy and the physical requirements of our increasingly digital civilization. We will now dedicate $1,000 to dividend growth stocks, which represent a more conservative and income-focused approach. This is important because consistent dividend increases are a proven signal of a company with strong management and a durable competitive advantage. For example, look at companies known as dividend aristocrats, which have raised their payouts for over 25 consecutive years. These businesses often provide a psychological safety net because you receive cash payments even when the market is trading sideways. Having a portion of your $10,000 in dividend payers creates a feedback loop of passive income. This strategy focuses on quality and cash flow, which are the two most important factors for long-term wealth preservation. The next $500 should be allocated to digital assets like Bitcoin or Ethereum, which have matured significantly by 2026. The reason for including these is that digital gold has become a recognized asset class for institutional investors and a hedge against currency devaluation. We can see this in the way that exchange-traded funds have made it simple for major pension funds to hold these assets. While the volatility can still be higher than stocks, the potential for asymmetrical returns makes a small allocation a very wise move. This 5% slice of your $10,000 provides exposure to the decentralized finance revolution. By 2026, these assets have proven their staying power and serve as a modern alternative to traditional stores of value. It is also vital to put $500 into emerging markets with a specific focus on the Indian economy and Southeast Asia. The reason this is necessary is that the demographic trends in these regions are far more favorable than the aging populations of the West. For instance, India has become the fastest growing major economy in the world with a burgeoning middle class. By investing in an emerging markets fund, you are capturing the growth of billions of people who are entering their peak earning years. This provides a geographical hedge against the possibility of a stagnant American or European market. Diversifying internationally allows you to participate in the global rise of the new middle class, which is a powerful economic force. We will then move $500 into real estate investment trusts that specialize in data centers and industrial logistics. The rise of e-commerce and cloud computing has made physical warehouses and server farms more valuable than traditional office space. Think about the massive distribution centers used by Amazon or the secure facilities that house the servers for Google and Microsoft. These properties generate consistent rental income from long-term contracts with some of the wealthiest corporations in the world. By using a REIT, you get the benefits of being a landlord without the headaches of property management. This allocation provides you with a steady stream of income and exposure to the physical infrastructure that supports the digital economy. A crucial part of our strategy is keeping $500 in a high-yield cash account or short-term government treasuries. The point here is to maintain a liquidity buffer that allows you to take advantage of market downturns or unexpected personal expenses. For example, when the market experiences a sudden correction, most investors are forced to sell their assets at a loss because they lack ready cash. By having this small reserve, you become a buyer when everyone else is selling, which is how true wealth is often created. In 2026, even cash generates a respectable return of 4 or 5% annually. This portion of your $10,000 provides peace of mind and the strategic flexibility to act decisively. The final $500 of your $10,000 investment should be spent on your own education and skill acquisition. This is the most important allocation because your ability to earn a high income is your greatest wealth-building asset. For instance, spending this money on a specialized certification in artificial intelligence could lead to a major salary increase. No stock or bond can offer a return on investment that high because the gains are scaled by your entire career trajectory. In the rapidly changing economy of 2026, staying relevant and improving your skills is the only way to ensure security. By increasing your human capital, you are ensuring that you will always have the resources to continue investing. Another area of interest for a portion of your growth capital is the cybersecurity sector, which is becoming a mandatory expense. The reason for this is that as our lives move further online, the cost of data breaches has reached trillions of dollars. Consider how a single security flaw can shut down a major hospital or a global shipping company, leading to massive damage. Companies are now treating cybersecurity not as an optional luxury, but as a core requirement for their survival. Investing in the firms that provide these defense mechanisms offers a recession-resistant growth opportunity. By adding this to your plan, you are protecting your portfolio by investing in the protection of the entire digital ecosystem. The final component of this strategy is the method of execution, which should be done through a process called dollar cost averaging. This is vital because it removes the emotional stress of trying to time the market and prevents you from investing at a peak. Imagine if you invested all $10,000 on a Monday, only for the market to drop 10% on Tuesday. By breaking your $10,000 into 4 chunks and investing them over 4 months, you lower your average cost. This disciplined approach ensures that you stay consistent regardless of the daily headlines or market fluctuations. Successful investing is often less about what you buy and more about the behavior you maintain over long periods of time. In summary, investing $10,000 in 2026 requires a balance of core index funds, tech infrastructure, and personal growth. We have covered how to build a foundation with market trackers and then layer on growth through semiconductors and green energy. Remember that the best portfolio is the one you can stick with for years, allowing compounding to do the heavy lifting. Please like this video and subscribe to the channel if you found this breakdown helpful for your financial journey. I would love to hear from you in the comments section below, so please tell me which asset you feel most confident about. Thank you for watching, and I will see you in the next video.